A powerful wave is washing through the financial markets. You can't miss it. This wave is made of money, and it is all flowing toward one idea: artificial intelligence. Stocks connected to AI are not just rising, they are rocketing upwards. Throughout 2024 and now, as we stand here on October 26, 2025, some of the largest companies in the world have seen their values expand at a breathtaking pace. It's more like watching a rocket launch. The names at the center of this frenzy are now household names. Companies like Nvidia, Microsoft, AMD, large institutions managing billions, individuals trading on their phones. So, what is the powerful engine driving this incredible rally? It is not just one thing, a combination of powerful forces all pushing the same way. First and foremost, real, tangible demand for AI tools across the global economy. Businesses, large enterprises, small businesses, they are racing to adopt AI to improve efficiency, to cut costs, to invent entirely new products and services. That foundational demand is the bedrock of the rally. Another major driver: massive capital investment from the world's biggest tech firms. Microsoft, Google, Amazon. These companies are pouring billions into AI infrastructure, constructing enormous data centers, buying up advanced chips, hiring armies of engineers. That spending sends a powerful market signal. It shows long-term strategic commitment to AI. This isn't a short-term fad, it's core to their future. The investment creates a virtuous cycle, fueling demand for hardware and for software across the AI ecosystem. Scarcity of essential hardware is also critical. GPUs. Only a few firms can produce them at the required scale and performance. That created a serious supply bottleneck. When demand outstrips supply, prices rise. Chip makers have profited handsomely, especially Nvidia. Finally, the human element, market psychology. Media amplifies the story. Retail FOMO, ETFs and mutual funds add steady demand. Well, while the excitement is palpable, a growing chorus of seasoned experts is sounding a note of caution. They aren't saying the AI revolution isn't real. They're warning stock prices may have gotten ahead of reality. The most common concern: valuations. A stock's valuation measures price versus underlying business performance, earnings, sales. Many leading AI stocks' valuation metrics have soared to bubble-like levels. High valuations mean investors are pricing in years of flawless, rapid growth. If growth slows even slightly, these expensive stocks could fall fast. Another big worry: herd behavior. Investors mimic the crowd, often ignoring their own analysis. When everyone buys because prices rise, momentum can drive prices to irrational heights, and the herd can turn just as fast. Experts also flag concentration risk. A huge share of gains came from just a handful of companies: Nvidia, Microsoft, a few other megacaps. The market's health is now heavily tied to this small group. If one stumbles, production delay, increased competition, disappointing earnings, it could hit the whole market disproportionately hard. Finally, overly optimistic forecasts. No company grows exponentially forever. Competition increases, markets saturate, growth slows. Disappointment can trigger a painful correction. The current prices leave very little room for error. Whenever stock prices rise this fast, people inevitably start making comparisons to past market bubbles. The most famous comparison is the dot-com bubble of the late 1990s. It ended in a spectacular crash in the year 2000. Investors poured money into any company with a .com in its name, driven by belief the internet would change the world. Yet many had no clear business model, no revenue, certainly no profits. When profits failed to materialize for most, the bubble burst, and trillions of dollars evaporated. So how does the current AI boom compare? There is one crucial difference. Unlike the dot-com era, many leading companies in the 2025 AI rally are immensely profitable. Nvidia, Microsoft. These firms are not just selling a dream, they are generating massive revenues and record-breaking profits from real customers willing to pay. The current rally is built on real earnings and tangible cash flow. That gives it substance the dot-com mania lacked. That said, we're not completely out of the woods. A bubble is defined not just by asset quality, but by the price investors pay. Even a great company can be a bad investment if you overpay. The danger now is euphoric expectations. The key question: can future earnings grow fast enough to justify these prices? In a market driven by exciting stories and media hype, it is essential to ground ourselves in the cold, hard facts. A data-first reality check can help us separate sustainable growth from speculative frenzy. We can simply ask three straightforward questions: profits, price, market concentration. First, are the profits actually rising? A stock can go up for many reasons, but if profits aren't growing, the rally is standing on shaky ground. Real growing profits generate real cash flow, the ultimate sign of a healthy business. Second, is the stock's price growing much faster than its profits? If profits rise 50% but the stock triples, investors are paying a huge premium for future earnings. This gap is a key indicator of market sentiment. A large expanding gap suggests speculation is driving price. Let's use Nvidia as a concrete example. Results have been phenomenal, but the stock price has risen even more dramatically, far outpacing earnings, meaning buyers are placing a massive bet on future potential. If that future fails to materialize, if competition heats up or demand cools, the stock could fall back toward earnings. Third, is the rally narrow? If gains come from just a handful of AI names, risk is concentrated and the rally is more fragile, like a table on two legs. When thinking about the future of the AI stock market, it is helpful to consider a few different potential outcomes. This isn't about predicting with certainty, but preparing for a range of possibilities. Let's start with the best-case scenario. The AI revolution accelerates faster than expected. Demand expands into every corner of the economy. Businesses upgrade systems. Cloud spend grows explosively. GPUs remain in short supply. That lets companies like Nvidia keep high prices and wide margins. Earnings and cash flow expand, justifying today's valuations. Stocks rise at a more sustainable pace. Now the base case. AI continues, but growth slows. The initial surge becomes measured, long-term adoption. Some execute and thrive, others face challenges. Competition increases, margins compress, performance becomes mixed. A healthy correction, down 10 to 30%, shakes out excess. Then the market stabilizes and resumes a gradual climb. Finally, the worst case. Expectations collide with disappointing reality. New capacity brings chip prices and margins down. A surprise rate hike or downturn compounds it. Panic selling triggers a deep, rapid drawdown, a classic bubble burst. Thinking through these scenarios is meant to empower. By understanding the range, you can prepare your strategy. The future is uncertain, but a well-prepared investor is better equipped to handle it. To navigate the uncertain road ahead, investors need a dashboard of signals to watch. These indicators provide early warnings. The most important signal is quarterly earnings. Every 3 months, the numbers tell the story: revenue and profit trends. Accelerating, steady, or slowing. A single bad quarter might not be a disaster. A pattern of slowing growth is a major red flag. Company guidance is just as important. Stocks often react more to guidance than to past results. Nvidia lowers forecast. Negative signal. Microsoft lowers. Same. Beyond companies, watch sector valuations, price to earnings and price to sales. High sustained ratios mean the market is stretched. A gradual decline is healthy. A sudden spike then sharp drop is classic bubble burst behavior. Monitor flows into and out of AI funds. Large outflows, sentiment turning. Watch macro. Rising rates make borrowing costlier and bonds more attractive. Inflation or weak growth could be the pin that pricks the bubble. The AI rally didn't happen in a vacuum. Your dashboard helps you react early, not late. So, should you be worried? A healthy dose of caution is not just wise, it is necessary. The rally is supported by real, fundamental growth. This is not a phantom boom. However, prices have been driven to extraordinary heights by intense optimism and speculation, strong fundamentals, euphoric sentiment, A market highly sensitive to news and prone to large swings. If you own these stocks, do not panic. Be deliberate. Know exactly why you own them. Business model, competitive advantages, long-term prospects, or was it just FOMO? Investing based on hype is a dangerous game, like sailing in a storm without a compass. Do not bet more than you can afford to lose. It's easy to over-allocate to high flyers. Establish clear limits and stick to them. Worry is destructive when overexposed, constructive when it prompts risk review. Ultimately, AI presents massive opportunity and significant risk. Elements of sustainable growth and speculative bubble coexist. The worry isn't whether AI is the future. It's the price you're paying today. Markets reward disciplined, patient investors. They punish performance chasing and planless buzz. Given the high stakes and uncertainty, what practical steps can a cautious investor take? The most important strategy is diversification. Do not put all your eggs in one basket. Hold a mix. Stocks across sectors, bonds, other assets, you lower overall risk. If AI tumbles, other holdings cushion the blow. Set strict position limits. For example, no single stock CO 5%. AI sector not to exceed 20%. These are guardrails against over-concentration. Stick to limits, rebalance periodically. Take profits and redeploy into less inflated areas. Active managers can set stop-loss orders or target prices, automate discipline, lock gains when plan says so. Always keep some cash on the sidelines. Cash reduces risk and lets you buy great companies on dips. Prefer simplicity? Consider dollar-cost averaging, fixed monthly investments, or broad index funds ETFs like the S&P 500. Includes AI leaders while spreading risk. The AI rally is real, but prices are steep. Stay grounded, control risk, follow your plan, and participate without becoming a victim of the hype.